Okay. Hello and welcome everyone to this week's edition of Trinity Talks. My name is Eric Philippink. I'm a counsel here at Trinity's office in Washington, D.C. To be with you today to bring you this latest edition. Our Trinity Talks series brings to you topics of current interest in the development finance sector. Last week, for those of you who joined us, we discussed the sanctions regime in the United States and gave you practical tips on how to draft sanctions provisions in your finance agreements. This week, we are bringing you a topic on the oil and gas industry, O&G OMG, the impact of COVID-19 on oil and gas markets. We are also pleased today because we are bringing you a special guest who works with us. We are bringing you Max Vautier, who is Managing Director of LNG Value Limited, and he will be speaking to us today with partner Rinku Bedoria, who works in our London office. And so let me just give a brief introduction about Max. Max is the Managing Director of LNG Value. He has worked for many years in the energy sector, starting out working for major energy companies, BP and Suez. In 2003, he set up LNG Brokers and then launched LNG Value in 2014. LNG Value is a commercial advisory services company that works along the whole energy chain. They work on several major projects, including regasification and gas to power projects. And with that brief introduction, I will turn the presentation over to Max Vautier to start today's discussion on the oil and gas markets in light of COVID-19. So Max.
Thank you very much, Eric, and good morning, everyone, or good afternoon. I would like to start the presentation with the oil market before going into the gas market. The consequences on the oil market have been quite dramatic. In the pre-COVID-19 period, we had a long period of stability of prices, which have stayed in the range of 60 to 65 US dollars per barrel range. Early 2020, with two factors. One, the breakdown of OPEC Plus, and particularly the spat between Saudi Arabia and Russia. This has led to a no limits production and market share maximization. And the second, of course, is COVID-19, which has triggered an instant 30% fall in global oil demand. So the combination of these two factors have led to a crash in prices to below $20 per barrel, which was reached in April 2020. In the meantime, the futures market, the contango, of course, has increased a lot and has incentivized floating storage up to 200 VLCCs on floating storage, which has led to a major overhang. So the market has since, of course, recovered to a range of $40 to $45 per barrel, following the end of COVID-19 lockdown, and also the agreement at OPEC Plus for a 9.7 billion barrels per day cut in production, which has subsequently been reduced to 7.7 billion barrels per day in August. However, the market remains very volatile and fragile, given still the low demand, a 10% drop year on year, and of course fears of a second wave of COVID-19, which in fact are materializing now. So in particular in the US, we have seen a major hit in the oil production because it is a flexible production, and at current price levels, only low-cost producers can make a profit. Now, the the long-term consequences of what happened have more permanent effects on the oil market. First of all, the global oil demand, which was already relatively stable, is now expected to be capped over many years. We was talking a lot of peak oil. Now, even BP suggests that we have reached that point. We have seen the top of the demand at around 90 million barrels per day. The oil companies, both IOCs and NOCs, have been hit financially. Of course, they have suffered operational losses and write-downs on asset reserves due to the expected continuation of weak markets. So these have been already done in the balance sheets of these companies. As a result, the exploration budgets were cut to the bone. Already announcements were made by major companies such as Shell and Total, a reduction of up to 50% of the exploration budgets. And only lowest cost oil reserves now expected to be developed. The other element on the long term is the consolidation which is expected with M&A activity. We have seen the first post-COVID-19 transaction with the acquisition of Noble Energy by Chevron. So we can expect in the following months large financially strong companies to acquire smaller and weaker peers. Now, in the meantime, oil companies are under very strong pressure, which has started before COVID-19, but which has accelerated, to reduce carbon footprint and increase share of renewable energies. So this is going to be a long-term now major factor. And in these circumstances, gas retains an advantage over oil and is considered by most participants as a transition fuel. Even some believe that we should accelerate even further and go straight to renewables, but gas will remain, at least for the next 10 years, the transition fuel. So in conclusion, the oil markets have taken a major and long-lasting impact from COVID-19 at a time of structural environmental shifts away from fossil fuels. The next slide, I will turn into the gas market, and starting with the short-term implications of COVID-19. We have to understand that global gas market had already shown significant weakness in 2019 due to overproduction. The US had already dramatically increased its production, exporting LNG to global markets, 6 LNG export terminals with a total capacity of 85 BCM per year. The incentive for these projects was the low cost of LNG production in the US, between $0.5 and $2 per million BTUs at well, and also the low liquefaction capex costs, and which translated into less than $2.50 per million BTUs for liquefaction. And this applies to both greenfield and brownfield projects. Australia has also emerged in the last few years as a major LNG producer, with a capacity at par with US and Qatar of the order of 80 million tons per annum. So if we look at the demand now, despite the growing demand at a healthy rate coming from China, India, etc., the market has not been able to absorb such a quick increase of LNG production, and this has been seen already in 2019 with prices which have dropped from $7 to $8 per million BTUs to around $5 per million BTUs. So COVID-19 in the early 2020 has come at the worst time for the gas LNG markets. There has been an instant loss of demand, and combined with the continuing high level of production, because producers have not adjusted automatically, except maybe in the US. So this has led to a price collapse to historical lows of sub $2 per million BTUs on a delivered basis, which we have not seen for quite a long time. Now, there have been a number of knock-on effects from this gas LNG price collapse. The first one is that obviously the oil-indexed long-term contracts have become cheaper for gas due to the low oil prices. So that was purely mechanical, but they were still above spot LNG prices during the lockdown period. So this has led to cuts of volumes on these long-term contracts, up to, of course, the contractual limits, and deferrals of cargoes to later periods, late 2020 and mostly 2021. The other factor is that spot LNG prices have become very attractive and competitive with other fuels, such as oil and coal, although benefits for buyers were limited, at least in this first period, in the short term, given the large drop in demand. The loss-making producers, on the other hand, have cut their production, particularly in the US, and therefore we can expect that some production could be lost permanently. Finally, there has been another effect, is that LNG off-takers in the US could not cover even variable costs, production costs and shipping, and they decided to forego most of their entitlements. Between 15 and 35 export cargoes per month were lost between June and August 2020. In fact, the total in that period of lost cargoes has been of the order of 100. So this has been quite significant. So as a result of these deferrals and shut-ins, as well as several maintenance programs which were planned already, but also opportunistic or even forced, which were launched by LNG producers, prices have now rebalanced to a level of around $4 per million BTU. Now let's come to the long-term effects of. I'd like to see the previous slide, please. Yes, that's the one. So the impact from COVID-19 now in the long term are the following. First of all, the very low prices we have seen and the expectation of continuing price weakness over the next few years has been a major financial blow for, of course, gas LNG producers. This has reduced in turn drastically their ability to invest in exploration and production for new gas fields. Of course, this depends on the size and the type of company. Some major companies have been able to weather that, but some even medium-sized companies have been seriously affected. Also, in the current level of spot prices, several producers, especially in the US, will be making losses and will reduce production permanently. Now, on the demand side, the low gas LNG prices will attract a new increased demand, especially from Southeast Asia, China. And therefore, the expectation now is that global gas LNG demand will, first of all, catch up to a great extent the lost volumes which we have seen, and is expected to regain its pre-COVID-19 growth path of 3 to 4% per year at a minimum. It could be up to even 7 to 8%. So let's say here, contrary to the oil market, we will see again a resumption of the growth of demand. Now, also another factor on the long term is that in view of current uncertainties, several LNG export project FIDs will be postponed, other than those which are already at an advanced stage, such as Mozambique LNG. And this in turn will probably lead to a demand gap and higher prices by 2024, 2025. This is what I mean, this is a cyclical event which we have seen also in the past, and we will probably see the same now. So I will pass on to Rinku.
Thank you, Max. I'm going to jump in here just for a moment before we go on to Rinku, just to point out to our audience that we will be answering questions at the end of this session, and they can find a question and answer button. It has the question mark at should be at the top of their Microsoft Teams page. And if they press on that, they can send us a question that we will have answered later in the presentation after we have concluded the topic for today. And now I'm going to send it over to Rinku, who will continue with the presentation.
Thank you, Eric, and good afternoon, everyone. So the crisis has led various counterparties to consider carefully the contractual options as well that are open to them to help mitigate the impact and the challenges facing them. In the next couple of slides, we're just going to run through a few of the provisions that we've seen that have been tested over the course of the last few months in oil and gas contracts. So we'll start first with force majeure. That has been a clause that has been scrutinised in a number of industry contracts, and oil and gas is no exception. Certain Asian buyers have declared FM in their LNG contracts already. And I think there's quite a lot to say about force majeure, but for the purposes of this presentation, the key takeaway is that there is no single standard force majeure clause in any contract. It is not a concept enshrined within English law for English law contracts, unlike some civil law contracts. So it must carefully be considered in its own contractual context. It's worth bearing in mind that the affected party is likely to have to demonstrate how the FM event has disrupted its ability to perform its obligations, and also what steps it has taken to mitigate or avoid that disruption. So invoking an FM clause should not be taken lightly. Next on the list, liquidity and credit is increasingly becoming a cause for concern for many participants in the market. And many participants will be looking closely at their counterparties' credit risks. In an oil and gas joint operating agreement context, for example, they'll be looking at deferral rights for cash calls, and also what happens if a party is not able to make a cash call if it defaults upon it. Does another participant have to then fund the cash call? Does the defaulting party lose decision-making rights and ultimately forfeit its own participation? Parties will also be looking for ways to bolster credit risk in the form of security and credit support such as LCs and guarantees. Another point relating to the upstream joint operating agreements is operator insolvency risk. Quite often in these sorts of agreements, you'll see a commingling of funds to fund work obligations, and counterparties will be potentially looking to see if they can put monies into escrow accounts or indeed make the payments directly. The JOA may provide a regime as to what happens if the operator becomes insolvent. You may see that the party with the largest participating interest then takes over that role. But it's also important to see how that impacts upon the production sharing contract or the concession. So next slide, please, Eric. Thank you. Another clause similar to the force majeure clause will be the material adverse change. As we mentioned in force majeure, it is very much open to each individual contract as to how the clause gets interpreted. In an oil and gas contract, we will typically see material adverse change qualifying events or defaults. And again, the key points here are the scope, to look carefully at the scope of the MAC provision. Does it capture just the borrower, or sorry, not the borrower, the counterparty or the group companies? Does it look at the operations or the performance obligations of the party, or does it go further than that? Does it look at the business and the prospects as well? There is not a whole lot of case law, despite all the debate around MAC clauses on their interpretation, but I think it's fair to say that judicial guidance states that it should not be based on a temporary event. So it may still be too early to invoke MAC as a sort of default event. Price review clauses are commonly found in oil and gas agreements. The trigger will be important for whether that clause can be invoked. Does it relate to, again, like MAC, a sort of market-related change? Is it a permanent market-related change? There will be temporal restrictions usually on calling that price review trigger. Does it kick in, say, once a term over the contract, and who has the right to call those clauses as well? Is there a floor or ceiling on the revised price, which again can limit the parties actually wishing to invoke the clause? LNG diversions become quite significant for LNG contracts, whereby parties will want to divert cargoes away from receiving terminals that are suffering from shutdowns or suppressed demand. Again, it's important to look at any contractual restrictions relating to such diversions, sort of geographic, market-based restrictions, temporal ones. Are there particular volumes, amounts that are limited, and also the notice period for actually exercising diversion rights, as this can affect, amongst other things, the economics of the diverted cargoes, because given this is a fast changing global situation, demand can be suppressed pretty quickly in the markets to which a party may be looking to divert the cargoes to. There may also be increased transportation costs, for example. Downward volume flexibility, you sometimes see that right in gas or LNG contracts. Generally, it's normally quite marginal, but it may help in, again, meeting demand requirements. Important to note that you'd usually see a make-up obligation in relation to those volumes. So, it is not an inexhaustible remedy. Could move to the next slide, please, Eric. So we just touched on sort of some contractual consideration in existing contracts, but undoubtedly there has been an impact on new projects at development or construction stage as well. I think the overriding theme, as Max touched on as well, is delays. So there's been postponement of work commitments under production sharing contracts and concessions. And here the role of governments becomes quite important. Will they grant extensions for some of these work obligations, or will they let them lapse? We've seen supply chain disruptions. So, for example, Canadian LNG projects have been delayed due to parts that have not arrived from Asia. Construction delays have been rife. There's been limited personnel being able to actually conduct construction activities. And I think all of this has led to a diminished appetite for the more costly, riskier frontier projects. There's also been some tension between long-term versus spot trades in the LNG market. Spot trading was increasingly gathering momentum, and in 2019 was 30% of the global share of LNG trades. However, producers may now look more towards longer-term contracts in order to finance their projects, and buyers may want to lock in those cheaper prices and equally look more to the longer-term contracts to take advantage of the current price conditions. There has also been an impact longer term on pricing, and I'll hand over back to Max to go through those with us.
Yes, definitely there has been an impact on pricing, and particularly on long-term pricing for new projects. The long-term, which now are of the order of 10 years, pricing is expected to be lower, and we already are seeing contracts which could see slopes closer to 10% versus 12 to 13% in pre-COVID periods, and 14 to 15% 5 years ago. So the impact is very clear, but of course discussions between buyers and sellers are not going to be easy. There are different expectations between the two sides, and this includes the choice between various indexations, oil-based, Henry Hub, TTF, JKM. So this could mean longer negotiations, which could in fact delay FIDs for new projects. So the long-lasting effects, which we have touched upon, are validating a permanent cap on future demand, especially on the oil side, and prices also possibly on the gas side. The situation is not the same, of course, between oil and gas as we have seen. But it will, in any case, oblige producers to be selective for investing into new oil projects, and it will accelerate the shift towards renewable energies. I would like to do a spotlight on Africa, and of course we can discuss afterwards with the Q&A on this. But the change in the market conditions are providing African countries challenges as well as opportunities. The challenges, obviously, the direct financial impact is being felt by existing oil and gas producing countries and companies from this new low price environment, like Nigeria, for example, but also gas producers. And the new production capacities and export projects will be more difficult to develop in these new market conditions. And they will require more sophisticated pricing, marketing tools, which we can discuss later on, and project finance expertise. So these are the challenges. Now, the opportunities is that because of this low gas pricing environment, energy-hungry African countries can benefit from the low gas pricing environment over the next few years at least, thanks to floating LNG import solutions. We have seen already this in Ghana, Senegal, etc. So it's really an opportunity for these countries to take advantage of this price environment. And at the same time, the idea could be to develop their own gas reserves and gas production and export facilities, both onshore and offshore, with the aim of producing having a ramp up after 2024, which is when the market is expected to be favorable to sellers.
Thank you very much. We will end the presentation there and move on to our question and answer period. Max, since you are up on the screen, I'm going to stay with you for the moment, and you had already begun to touch upon the African market in relation to LNG. So let me first pose you this question. In your view, what do you see are some of the key factors that are required to unlock the potential for LNG in Africa? I think you already set this up nicely with your last slide, but if you could explore it a little bit more, please, for our audience.
Yes, thank you. Well, obviously there will be a big competition now, which intensify between the various regions. But Africa has some very good cards in their hands. I think that it will be important to have an in-depth analysis of the production costs for new projects, because low-cost projects will be the ones which will fry, and therefore there has to be a big selectivity in screening the reserves to be developed. But the other thing which is important, I think, is that more and more customers are asking for, let's say, zero carbon contracts. This we have seen in the last few months already, and this can be achieved in two ways. One is, of course, to reduce gas slippage, to reduce gas flaring, to use gas for exports. So there are some, let's say, physical ways of reducing the carbon footprint. And there are also paper, let's say, ways of doing it, is to compensate the carbon which is in the LNG cargoes by other means like reforestation, etc. So this is a way to go, and it could lead also to renewables in Africa being used to decarbonate LNG cargoes. And this could be done through hydrogen. So I'm just giving this as one of the ways where Africa could have a competitive advantage. The other things which could be important is to develop domestic markets more intensely in terms of gas. This could be for power generation, but it could be also for distribution to industrial customers or even small grids. And also the possibility to participate more actively in the whole value chain. And finally, I would like to say that in the financing of projects, this will be quite a sensitive issue because, of course, also the banks have been affected by COVID-19, and therefore their also position, including on the carbon footprint, has changed, and therefore African countries could, let's say, have an advantage also there, but should use all the new financing tools which are available, including all the liquidity which exists in LNG markets and liquidity on the carbon markets. So these are a few thoughts that we can discuss more.
Thank you very much, Max. I'm now going to go back to Rinku. Rinku, I'm going to ask you the same question. Since many of Trinity's clients work on projects across Africa, Africa is a major market for our general client base. So I just wanted to see if you had some additional thoughts to what Max has just laid out in terms of the unlocking the potential for LNG across the continent.
Yes, in terms of the domestic market, I think volume certainty and scale will be key factors to unlocking that potential. Long-term LNG SPAs are usually the gold standard to achieve project financing, but in the absence of that, demand, techniques such as aggregation of off-takers or having sort of a bulk supply contract would be another way of ensuring that those projects can be developed and financed. So it's really about kickstarting the market, in my view. As Max touched on as well, widening the use beyond sort of power to petrochems and industrial customers and transportation would also help unlock that potential. In terms of the sort of export market, I think Nigeria LNG, for example, has shown that strong fundamentals to a project will always, you'll be able to get projects away even in these current conditions. LNG being a sort of very cash rich entity, and having an operational track record meant that banks were very easily able to come on board with that project.
Great, thank you very much. For our next question, Max, I'm going to come back to you to ask this to you. We've just focused on LNG for our previous question. Now let's take a walk back to oil. I've received a question here about the oil sector, and I'm going to ask you, how do you see the relationship evolving between international oil companies and national oil companies in light of the current landscape that you laid out in your presentation?
Well, I think that these relations will be impacted by the current situation, and I think the general view is that there should be more cooperation between NOCs and IOCs for many reasons. Of course, financial reasons, and also that the markets are becoming more integrated, and there is a real win-win between the two to achieve the development of projects, which would otherwise would not happen. And I think this is particularly applicable in Africa.
Thank you very much. So at this point, this ends our presentation for today, as we have exhausted the questions that we received. I want to thank our two presenters today, Max Vautier and also Rinku Badoria from our office in London. And just to conclude, I want to draw your attention to the fact that you can find the YouTube video recordings of all of our Trinity Talks sessions stretching back from the middle part of the summer. They can be found through our website. If you go to our website and click at the bar at the top, you will find the link to Trinity Talks. Also here on the screen, you will see the upcoming talks that we have scheduled for the month of October. Next week, we'll be talking about off-grid solar projects, how to de-risk your investment. And so with that, I want to thank our attendees for participating today, and thank everyone who may find us on YouTube in the future. So thank you very much, and I look forward to our future Trinity Talks with you next week.